What is financial feasibility analysis? Financial feasibility analysis is a financial analysis seek to project revenue and expenses, forecast come later and full business plan, project a financial narrative and estimate project cost, valuations, and cash flow projections. The financial analysis may typically include these items. Number 1, a 12-month profit and loss projection. Number 2, a 3 or 4-year profit and loss projection. Number 3, a cash flow projection. Number 4, a projected balance sheet. Number 5, a break-even calculation. A financial analysis should estimate the sales or revenue that you expect the business to generate. A number of different formulas and methods are available for calculating sales estimates. You can use industry or association data to estimate the sales of your potential new business. You can search for similar businesses in similar locations to gauge how your business might perform compared with similar performances by competitors. One commonly used equation for a sales model multiplies the number of target customers by the average revenue per customer to establish a sales projection. T times A plus S, where targeted customers times average revenue per customers is equal to sales projection. Another critical part of planning for new business owners is to understand the break-even point, which is the level of operations that results in exactly enough revenue to cover costs. It yields neither a profit nor a loss. To calculate the break-even point, you must first understand the two types of cost, fixed and variable. Fixed costs are expenses that do not vary based on the amount of sales. Rent is one example. While some costs vary from month to month, costs are described as variable only if they will increase if the company sells even one more item. Costs such as insurance, wages, and office supplies are typically considered fixed costs. Variable costs fluctuate with the level of sales revenue and include items such as raw materials, purchases to be sold, and direct labor. With this information, you can calculate your break-even point, the sales level at which your business has either profit or loss. Projected cash flow outlines preliminary expenses, operating expenses, and reserves, in essence, how much you need before starting your company. You want to determine when you expect to receive cash and when you have to write a check for expenses. Your cash flow is designed to show if your working capital is adequate. A balance sheet shows assets and liabilities necessary for reporting and financial management. When liabilities are subtracted from assets, the remainder is the owner's equity.
What is market feasibility analysis? Market feasibility analysis is a study that identifies the success of a product in a particular market. It helps to identify the potential markets, market competition, potential development in the market, and market analysis to evaluate the business idea. They are valuable for anyone looking to start a business. In other words, market feasibility study determines the likelihood of a product success in a certain market. Market feasibility analysis is feasibility tests are not just reports that are made to sell the business idea to the investors, but those are tools that will help to assess the business potential, which will consider both advantage and disadvantages in the business implementation in the particular market. Market feasibility studies are different from the marketing plan. Feasibility studies are usually conducted based on ideas, products, campaigns, process, businesses, and trends in the market. In certain instances, the feasibility study may include the changes in the operating the business, such as the acquisition of competitors or changing the production processes. As a result of this operation changes, the cash flow of the business also can be changed. Assessing the risk factor is more important in situations like this.
Hello everyone, I'll be reporting the topic How to Prepare a Financial Feasibility Study. When business owners have an idea about a new project, they first conduct a feasibility study to determine its viability. A complete feasibility study would examine the market, analyze the technical and production issues, analyze the economic factors, and include the preparation of financial analysis. Managers prepare feasibility study to identify the positive and negative issues before making an investment of time and money. Purpose of financial feasibility study focuses specifically on the financial aspects of the study. It assesses the economic viability of the proposed venture by evaluating the startup cost, operating expenses, cash flow, and making a forecast of future performance. The preparation of financial feasibility study has three parts: determining the startup costs, assessing the return on invested capital, preparing a profit plan, and making a cash flow projection. These are some examples of startup costs: purchases for land and buildings, acquisition of equipment, licenses and permits, employee wages, marketing research, advertising, etc. Prepare profit and cash flow projection. The analysis that evaluates if the planned project will be financially feasible is the preparation projected sales, expenses, and cash flow. These projections include the projected sales, cost of production or services, and operating expenses separated into fixed and variable categories. The cash flow predictions show how much money is needed to get started and where it will come from. All borrowed funds and leases are calculated, as well as the quantity sources of equal capital. Explain negative cash flows. If the project will have negative cash flow in the first few months, the amount for that month should be estimated. An explanation should be provided as to how these cash flows shortfalls will be financed. Calculate periods of negative cash flow and pinpoint when more money is required by using profit and cash flow estimates. If internal cash flow isn't enough, you'll need to borrow money to fund expansion. The projected profits will be used to determine the financial feasibility of the project. This part of the financial study assesses the attractiveness of the project to equity investors and the overall financial return on the project. The financial feasibility of a proposed venture can be estimated using NPV, net present value, IRR, internal rate of return, and payback period. Net present value method uses a percentage rate to discount future cash flow to the present. If the NPV of the discounted cash flow exceeds the cost of the initial investment, then the project is feasible and should be accepted. Internal rate of return method uses the same formula for calculating the NPV of cash flows. The IRR is a discount rate that makes the NPV of cash outflows and inflows equal to zero. This IRR can be used to compare the attractiveness of several projects. Payback period is the number of years that it takes for the return from a project to recover the cost of the investment. A shorter payback period are preferred. The payback method ignores the time value of money that's used in calculating the IRR and NPV of a project. Financial feasibility study versus business plan. A feasibility study isn't a business. A feasibility study is intended to determine if proposed venture is a profitable idea. A business plan is a detailed plan on how the venture will be implemented and managed successfully. A financial feasibility study should be conducted at the onset to determine the economic viability of a proposed venture before proceeding to the preparation of a business plan. It identifies the startup cost, make projection of profit and cash flow, and determine the return of investment. How to write a marketing feasibility. Market feasibility studies help identify market competition, potential markets, and market analysis to assess a business idea. They are valuable for anyone looking to start a business. Market feasibility study is different from a marketing plan. Feasibility studies are done on ideas, campaigns, products, processes, and entire businesses. They look at how things work and if there are potential problems. Feasibility studies are assessment tools, not just reports to try and sell your business to investors. They should consider both the pros and cons and analyze a variety of potential business scenarios. A marketing plan maps out specific ideas and campaigns based on feasibility study investigation and are intended to be implemented. Think of a market feasibility studies as a logistical study and a marketing plan as a specific planned course of action to take. What to include in market feasibility study? Market feasibility study should include a description of the industry, current market analysis, competition, anticipated future market potential sources of revenue, and sales projection. How to write an industry description. Give a brief 1 to 2 paragraph description of the industry your business is in. Analyzing your current market. This section of market feasibility studies describe the current market for your product or service. If you are offering something so unique that there are few market statistics, you can either use related industry information or conduct your independent study. Several ways to conduct your research for new ideas include polling internet forums, sending out questionnaires, addressed to targeted consumers groups, or the general population.